Good afternoon, ladies and gentlemen. Welcome back to this week, 22nd April weekly market review. We have with me today Mr. Gerald Wong, as usual, to help us break down what has happened in a very tough week on the market last week. How are you, Gerald?
Yeah, so you're right to say that quite a number of developments in the markets. We saw rising geopolitical tensions while the market is still reacting to the potential delay in Fed rate hikes. So quite a number of different things that are moving the market at this point in time.
Yes, so last week, in the middle of the week, we heard the Fed chair saying at a forum that if there's a need to keep interest rate high as needed, they are prepared to do it. And of course, Friday morning, we have that Israel and Iran event that happened that caused a little spike in the oil price, but now oil price is back to the level that is before that event. And of course, we have a very heavy earnings week coming up. Some of the REITs has also reported. We'll be going through some of that with us today.
Yes, so as usual, what I will do is to provide a macro update first. Today's sharing is for information purposes and will not be taken to be financial advice. Okay. If you find the weekly market review helpful, do leave us a review on Google. And if you'd like to join SIAS as a member, it costs $12 per year. You can go to this website or scan this QR code. Okay, so what we saw last week was a fall in the S&P 500 as well as the STI. Most of the losses were led by the tech stocks. So what we see here, the Nasdaq was actually down 5.5%. So a very significant drop given what we will be sharing later in terms of how we are seeing the interest rates going up once again. Okay, so this is effectively what we see for the US 2-year government bond yield. If you look at where it is now close to the 5% level, so effectively back to where it was in November last year. So as a recap, given the expectations of Fed rate cuts this year, it came down very sharply in November and December last year and reached as low as about 4.1%. But now, given the expectation that the Fed might delay the rate cuts, we are looking at it back to the 5% mark once again. Okay, we see that in the 10-year government bond yield as well, also back to where it was in November last year. Okay, so this is really a reflection that inflation has been quite persistent, and with that, investors have actually tempered down their expectations of rapid rate cuts in 2024. Okay, I think apart from that, we also saw more geopolitical tensions that have also impacted the market. So with that, we see that the volatility in the market has gone up. The VIX here is actually now close to 19, which is the highest level since October last year, where we also saw this spike in geopolitical tensions. So this is being reflected in the Singapore market. When I was updating this chart, once again, amongst the STI, there were not sufficient stocks to make up the 5 top gainers. The best performing sector last week was the banks, with UOB up 1.2%, DBS up 0.8%, and OCBC still doing better than the index, but still down by 0.6%. Okay. So if you recall, the previous expectation is that with the potential rate cuts coming through, the net interest margin of the Singapore banks might be impacted this year. But given now the expectation is that the interest rates may stay higher for longer, investors are turning a bit more positive on the Singapore banks once again. Okay, the reverse is actually happening for the Singapore REITs. So in terms of the worst performers in the STI last week, quite a number of them would be the REITs, having fairly significant falls, with Mapletree Logistics Trust down by 9.7%, Mapletree Pan Asia Commercial Trust down by 8%, and Frasers Logistics and Commercial Trust down by 6.7%. Okay. So this is really because of the higher yields that we see, not just in the US, but in the Singapore market as well, where the 10-year Singapore government bond yield has gone up, and that is once again driving concerns that the REITs might face higher financing costs, and also potentially that the dividend yield that they are now offering is not attractive enough compared to maybe a risk-free asset like the Singapore savings bond. Okay, so we also start to see some of the REITs reporting their results. Last week, we had CICT as well as Keppel DC REIT providing an operational update. So I will talk about these two REITs today, starting with CICT. What we see here, like a lot of the other REITs, there's this fall in the share price in April, given the expectation of the higher yields that we are actually seeing at this point in time. But I think for CICT, given that the share price is at 188, it is still above where it was back in October, where it actually came down to close to 170 per share. Okay, so I think what investors generally appreciate about CICT is that it has got a diversified portfolio, and most of the assets are actually based in Singapore. Okay, so if I look at the breakdown by the sub-segment, retail is at about 30%, office is about 39%, and the integrated development would be at about 30%. Okay, so that was what I meant by diversified, because it's not just exposed to one single sub-segment. And if I were to look at the breakdown of the geography, Singapore would be where most of its assets are. You'll probably be familiar with some of its retail assets. So we see that that is actually helping the REIT's performance, given that Singapore has been fairly resilient so far. Okay, so what did CICT report for the first quarter? Generally, we see a fairly resilient performance with the gross revenue up by about 2.6% compared to the previous year. And the net property income is up by 6.3% compared to the previous year as well. Okay, so the performance based on the net property income has been actually fairly resilient across all the different subsegments. So whether is it retail, office, or integrated developments, we saw that the net property income actually went up compared to the previous year. Okay, if I were to look at the occupancy, then what we see here would be a mixed picture. Retail seems to be doing a bit better, where we saw an increase in the occupancy in the first quarter compared to as of December. But office is where we see some signs of weakening in terms of the occupancy rate, where it came down from 96.7% to 95.8%. So with the lower office occupancy, the entire portfolio occupancy came down slightly to 97%. Okay, still a very healthy level, but just down compared to the fourth quarter of last year. Okay, so if you were to break it down further to take a look at the office occupancy and what is driving the decline, Singapore actually saw a decline in the occupancy rates. Okay, and likewise in Germany as well. But because Singapore is the bulk of its portfolio, like what we saw earlier, so this is probably where we need to keep a closer lookout for. And when I looked at the investor relations slides, the company had explained that this was driven by one of its properties, which is Capital Green, which saw lower occupancy in the quarter. Okay. The good news is that the average rents of the Singapore office portfolio still continued to rise. So in the first quarter, at $10.63 per square foot per month, which is higher than what it was in the previous quarter. Okay, the retail portfolio is where we see more positive signs. So there has been an increase in the tenant sales across the suburban malls as well as the downtown malls. And there has been higher shopper traffic across the suburban malls and downtown malls as well. Okay, so this is helping the retail segment of its portfolio. And if I were to look at the balance sheet of CICT, the leverage level is pretty much unchanged compared to the previous quarter at 40%. Okay, it has got a significant portion of its debt on a fixed rate at about 76%. And the average cost of debt has been relatively moderate at about 3.5%. So not too much of an increase compared to the previous quarter where it was at 3.4%. Okay, so what we see here for CICT is that dividend yield of about 5.85%, quite close to where it was over the past 1 year. So for investors who might be looking at which REITs actually offer a higher dividend yield compared to, say, maybe the Singapore savings bonds, then CICT might be something that has got a fairly diversified portfolio and has been able to grow the net property income, even though we'll keep a very close lookout for in terms of the office occupancy rate, where we have started to see some signs of deterioration. Okay, next, we'll take a look at, just one point on CICT in terms of the price to book valuation, now at about 0.9 times price to book, which is in line with the historical average. Okay, next, I've been getting quite a lot of questions about Keppel DC REIT because the share price has come down to close to its 1 year low at about 164. So earlier we saw that for CICT, the price is still above where it was in November last year, but for Keppel DC REIT, it has actually fallen to below where it was in November last year. Okay. So we can take a look at Keppel DC REIT's first quarter results. What we see here is that the gross revenue went up. This was because of some of the recovery that it was able to make for a tenant that it previously had some challenges on. Okay, but we actually see that the property expenses went up sharply. This was because it had to make certain allowances for its tenant in Guangzhou, China, where it is facing some challenges with. So that actually put down the overall net property income, such that even with the recovery that we see for the tenant, we are not able to see a very sharp increase in the net property income. Okay. If you look at the overall finance cost, it has also gone up, which has actually led to the distributable income being down on a year-on-year basis. And the REIT actually announced a distribution per unit of 2.192 cents, which is down 13.7% compared to the previous year. Okay, so this decrease in distributions probably driving concerns for investors, which is driving down the share price as a result. Okay, so outside of the tenant in Guangzhou, what we see is that the occupancy rate for Keppel DC REIT is still fairly decent at 98.3%. They've been able to secure new renewal contracts with positive reversions. So I think that reflects the general trend in the data center market, where the structural growth is actually still fairly positive. Okay, if I were to look at the balance sheet of Keppel DC REIT, what we see here is that the aggregate leverage has gone up just slightly to about 37.6%. And in terms of the average cost of debt, they managed to reduce it slightly compared to 31st December 2023. Okay, so hopefully with this, and if interest rates do not rise further, we might see a moderation in the increase in finance costs in the subsequent quarters. Keppel DC REIT also recently announced a divestment, which is intended to unlock value for the REIT. They were able to sell this asset, which is the IntelliCenter campus, at a premium to their original investment, as well as a premium to the book valuation. So this will actually help to unlock some capital, and is also expected to be able to allow it more leeway to be able to manage its balance sheet. Okay, so what we see for Keppel DC REIT is that current dividend yield of about 5.4%, which is higher than the historical average. We just need to keep a very close lookout for whether we will see a sharper than expected decline in the dividends, which will potentially impact how its dividend yield would then pan out over the next 1 to 2 years. Okay, so we started to see the Singapore REIT starting to report their results, but we have a lot more of that coming through this week. We have got CapitaLand Ascendas REIT, we've got Mapletree Pan Asia Commercial Trust, we have got Mapletree Industrial Trust. So quite a number of REIT results to keep a lookout for. We also have the US mega tech stocks actually reporting their results. So Tesla, Meta, Alphabet, and Microsoft all reporting this week. Okay. We also have got a 6-month T-bill auction in Singapore this week. Okay, so for those of you who are looking for the ability to earn a yield on your savings, that's something to keep a lookout for as well. Okay, so with that, I'll hand over to Sunny, who will share with us how the technical indicators are looking and how we should prepare ourselves for the market going ahead. Sunny, over to you.
Okay, thanks, Gerald, for that sharing. And your last slide of what to look out for this week really sets me up nicely of what I'm trying to look at this week. So I just want to go through the earnings calendar like what Gerald said. So Tuesday, we'll be looking at Visa and Tesla reporting. So I think a lot of people will be watching Tesla as well. And then on Wednesday, we have Facebook parent Meta reporting as well. And on Thursday, we have Microsoft and Alphabet, of course, the parent of Google. So a lot of big tech stock will be reporting their earnings results. And that is crucial for us to see whether the rally in the AI tech sector can sustain going forward. Already we see quite a significant pullback on the Nasdaq Composite Index, especially what Gerald flashed just now, a 5.5% pullback for the week on the Nasdaq Composite Index. So we need these earnings of the big tech companies to tell us that, hey, the revenue is still going up, the outlook is still positive, so that the rally will still continue. Else, I believe the correction might gain a bit more strength if the earnings were to miss the consensus. Okay, the next thing that I'm looking at, of course, will be oil price related to what happened last Friday. So we saw oil price spike of especially the Brent crude oil spike above the $90 mark last Friday for a very brief period in the first half of the Asian trading period. After that, it starts to subside down again. And once the US started trading on the Friday evening, we can see that oil price has been back to the level where the conflict started on Friday morning. So not much of a concern right now, but I'm just keeping this on my radar, on my watch list in case there's a spike in oil price again. Then we know that something is happening in the Middle East, and that's when the news will come out. So the oil price will normally move first before the news come on to your website or your news channel. Okay, back to the charts. On the STI first, this morning, 22nd April, we see a very big jump, a 1.53% jump on the STI index. It went to as high as 3,238 points this morning. The reason I would say would be because last Friday, we have that conflict between Israel and Iran. Market was a bit negative. There was a flight to safety. Hence, there's a bit of a sell-off last Friday on the 19th of April. And fast forward to this week, Monday, over the weekend, I think things subsided. There's not much of a news of any escalation or intensification. Hence, market starts to be putting on the risk-on cap again. So that's why you see the STI index now jumping over 1.4% right now. Okay, last week we were at over here, 15th of April, Monday, we were saying that the STI was resting comfortably on the long-term moving average, which is a 200 days moving average in red over here. I noted that if it were to come down to this level over here, then this would be the level that we should be looking at to get into the STI index. And nicely, the next day on the 16th of April, we see STI hit a low of 3,136 points. So we mentioned that the 3,150 points is the crucial level to look at for the STI index should a bounce happen because of this uptrend support line that we are seeing. For it to sustain, the 3,150 must be defended. And once we see that it tested this level, and then you can see some of a convincing rebound on Wednesday and Thursday, before the red candle on Friday due to the Israel conflict. And this morning, we have a continuation of that rebound upwards. We reached 3,238 points. And then the target that we are looking out for will be the year-to-date high over here on the 28th of March. That is where the 3260, 3250 level is. And I highlighted this over this gray area over here. Once it hits this level, we should see some kind of resistance coming in. And that is probably somewhere that you should take profit first and then rethink or reorganize or see how the market has been developing to plan what your next step will be. On top of that, you also see the upper bound of the Bollinger Band at the 3269 level. So between anything above the 3250 level would be something that you need to watch to see if there will be a rebound downwards or a pullback towards the 200 days moving average again, now around the 3,180 point levels. On the MACD indicator, it is developing quite positively. We can see that the MACD line starts to converge towards the signal line. And the last 3 trading sessions, we saw that the MACD histogram do indicate or tell us that there is a subsiding of the negative momentum that we saw since the March, early part of April period. So we are looking at a rebound or to retest the year-to-date high according to the MACD indicator. On the RSI, the latest reading at 55 points is also above its 14 days moving average of 52 and also above the 50-point neutral mark. So this trajectory from the low of 16th of April at 38 points to the current one that we see at 55 tell us that the rebound momentum upwards is actually increasing. And hence, this momentum is likely to continue towards the 70-point overbought mark. So we still have a healthy gap between this overbought level. So I think the SCI is likely going to rebound further upwards. Okay, so target will be the 3250 level, and this is the area over here that we are targeting for the SCI in the next few weeks, and we will update you along the way on our weekly market review. Next, let's go to the US indices, which may not have ended that well. Dow Jones Index still managed to eke out a 0.01% gain for the whole of last week, or just 3 points. Friday, it has a bit of a rebound because we do see the subsiding of the tension in the Iran-Israel conflict. So the Dow Jones Index is now resting on the 100 days moving average at 37,860 points. Last Friday closing was at 37,986 points. So I think there will be some consolidation over here. A lot of it would be dictated or directed by the earnings seasons. One of the key movers last week we saw was Amex, which reported their earnings, very positive earnings. Hence, their 6% gain actually helped the Dow Jones Index stay above the 100 days moving average. Okay, so looking at the indicators, the MACD indicator also showing some sign of positive. The negative momentum that we observed in the past 3 trading sessions seems to be subsiding, and I'm looking forward to the MACD line converging towards the signal line, telling us that the rebound is going to be sustained. On the RSI, we have the latest reading at 38, not very strong, but then we are very close to the 14 days moving average of the RSI at 40 points. So once we breach above that, that will be the first catalyst to tell us that, hey, this rebound is gaining strength and will persist in the next few weeks. And of course, once it goes above the 50 point, then we might even retest the year-to-date high at around the 39,890 points level. Okay, so this is the Dow Jones Index, still looking very positive with the earnings coming up. Visa that I talked about earlier, should they replicate the performance in AMX, that would be another boost to the Dow Jones Index as well. Next, let's look at the broad index S&P 500, which pulled back slightly more. So we are now also slightly above the 100 days moving average at 4,944 points. Last Friday closing was 4,967 points. But as compared to the Dow Jones Index, there is still no signs of a rebound yet or stabilization yet for the S&P 500 index. As you can see over here, the past 5 trading sessions has all been a negative trading session, as you can see on the charts. The MACD indicator is also telling us the same story, that the downside momentum seems to be accelerating downwards, and the RSI is at 31 points, 1 point above the 30 points oversold mark. I would just like to pull back the charts to see when was the time that we tested the 30 points oversold mark of the RSI, and that was somewhere in the October of last year where we saw the low at 4,114 points. And of course, during the September period as well, we came close to this level. So as you can see, once it hits this oversold level of 30 points, it starts to have a very strong rebound. So if the S&P 500 breached the 30-point oversold mark, then I think the rebound will start to come in, and probably the 100 days moving average would be a key pivot level to look at 4,944 points or 4,950 points. That would be an area that we are looking for a support to get back in. If that levels is able to give a very strong rebound, then that is where we could get in on the S&P 500. Okay, the Nasdaq Composite Index is, of course, the biggest loser last week on the among the US indices. The main key issue that the investors are worrying about is the tech sector. Of course, the interest rates uncertainty as well. We also saw Nvidia corrected 10% last Friday as well. So that is a key concern for the Nasdaq Composite Index. Adding on to the Israel and Iran conflict, there's a lot of flight to safety, a risk-off kind of mentality where investors are rotating heavily out of these growth stocks. So you can see that the Nasdaq Composite Index has already breached the 100 days moving average at 15,480 points. The next support level I foresee would be around the 200 days moving average that you see over here at 14,719 points. The MACD indicator is still telling us that negative momentum is still building up and not subsiding. So a near-term rebound is not in sight. And the RSI is touching the 30-point mark now, which is the oversold level. So it could have a rebound soon. So we could be close to a reversal, but then there is no. Both of these indicators has not confirmed that for each other. So it's still not 100%. It's still not a very convincing sign that a rebound will happen in the near term very soon. So if I'm going to pull back the charts again, you can see that somewhere around the October of last year, we also come close to the 30-point level, and then we had a rally. So if that scenario is going to replay again, then this is the indicator that we look out for. We need to pay very close attention right now, and then to catch the rebound if it's going to happen. So let's just put our support level now at the 14,700 points level, which is a 200 days long-term average for the Nasdaq Composite Index, and see if it touches this level, that could be a good strong support level for us to get in on the Nasdaq Composite Index. Okay, so I think a lot of movement this week will be based on the earnings season and the big tech earnings that will be coming out. So do look out for those earnings results that will dictate the market this week. Okay, Gerald, anything to add?
Yeah, so I think definitely looking out for the earnings that are coming out this week. Given that we have got a number of the large cap stocks actually reporting, I think that will really drive the direction of the market going forward.
Yes, and that is, I think, all the time that we have for this week. So I think everyone should keep a lookout for the earnings and do trade safe and stay safe. And we'll see you again next week in the next weekly market review.